Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. YCharts just released the results of their latest advisor communication survey, and the findings are eye-opening. One of the most shocking stats was that 75% of clients either switched or contemplated switching advisors last year. That's a huge jump from the 48% recorded in their 2023 survey. This leaves me asking, what can advisors do better to communicate with their clients based on what the survey uncovered? YCharts has a bunch of tools to help with this, and to highlight a few, they have the report builder and proposals tools that let you customize and personalize investing reports for each client. And scenario tool lets you run hypothetical investing decisions to share with clients and prospects. To learn how YChart's proposal generation and customizable client collateral can boost your overall client satisfaction and increase retention rates, download their findings with the link in the show notes. Get 20% off your initial YChart's professional subscription when you start your free YChart's trial. Tell them I sent you, or click on the link in the show notes for new customers only. Welcome, everybody. It's time for another Mebisode. Today's title, Should CalPERS Fire Everyone and Just Buy Some ETFs? Let's get started. Quote, he was a U.S. class smooth politician, which is the only way you're going to survive in that job. It has nothing to do with investing, end quote. That's how Institutional Investor recently described a former CIO of the California Public Employees Retirement System, also known as CalPERS. The description is especially interesting when considering that the I in CIO stands for investment, which raises an eyebrow at how the role could have nothing to do with investing. For readers less familiar with CalPERS, it manages pension and health benefits for over 1 million public employees, retirees, and their families. CalPERS oversees the largest pension fund in the country, recently valued at over $450 billion. With that massive amount of assets comes a great deal of scrutiny over how those assets are deployed. The CIO role, managing this pension, is one of the most prestigious and powerful in the country, hence institutional investors' interest. Apparently, it's also one of the hardest roles to hold down. The position has averaged a new CIO roughly every other year for the past decade. Now, this podcast isn't going to spend a great deal of time on CalPERS governance, as many others have spilled a great deal of time and ink there. Plus, the drama that consistently surrounds the pension is never ending and will likely feature a new twist by the time this podcast gets published. Instead, we're going to use CalPERS' investment approach as a jumping off point for a broader discussion about portfolio allocation, returns, fees, and wasted effort. And if we do our job correctly, we hope you'll feel just a little bit less stressed about your own portfolio positioning by the time we're done. Let's start off with the staggering waste of CalPERS' market approach. CalPERS' stated mission is to, quote, deliver retirement and health benefits to members and their beneficiaries, end quote. Nowhere in this mission statement does it state the goal is to invest in lots and lots of private funds and pay the inflated salaries of countless private equity and hedge fund managers. But that is exactly what CalPERS does. The pension's investment policy document, and I'm not making this up, is 118 pages long. Their list of investments and funds runs 286 pages long. Maybe they need to read the book, The Index Card, which details how to craft an investment policy portfolio just on an index card. Their structure is so complicated that for a long time, CalPERS couldn't even calculate the fees it pays on its private investments. On that note, by far the biggest contributor to high fees is CalPERS' private equity allocation, which they plan on increasing the allocation to, by the way. Is that a well thought out idea, or is it just a Hail Mary pass after years of underperformance? Recently, CalPERS disclosed that their venture capital portfolio returned a measly 0.49% from 2000 to 2020. Now, of course, it's easy to criticize, but is there a better way? Let's first examine CalPERS' historical returns against some basic asset allocation strategies. We'll begin with CalPERS' current portfolio allocation. And I'll just read this out, but you can find it in the show note links along with the other graphs and tables. Public equity is 45%, private equity 13.5%. So the two of those combined get you up to almost 60%. Income assets 26.5%, real assets 15%, private debt 2.3%, other trust level 3.1%. And if you notice, that doesn't quite add up to 100, it adds up to over 100. So they got about 5% leverage on this portfolio. So we're at 105% total allocation. Now, we know what CalPERS is working with. Let's compare its returns against three super basic portfolios. We'll take this back to 1985, which is the beginning of the years that I have CalPERS return data. So first, we'll do the classic 60-40, which is 60% U.S. stocks and 40% bonds benchmark. U.S. stocks is S&P 500, bonds is the 10-year U.S. government bond. Second, we'll do a global asset allocation. We use the moniker GAA portfolio. This is from our book, Global Asset Allocation, which of course is still available as a free ebook. You can go to mebfaber.com or Cambria Investments to download that. The allocation approximates the allocation of the global market portfolio of all public assets in the world. Third, we'll do the same GAA portfolio, but with slight leverage, since many of the funds and strategies CalPERS utilizes have embedded leverage, as well as the fund having leverage itself. So we're going to target 120% total leverage. So as you can see from this data and from the table posted in the show notes, from 1985 to 2022, CalPERS fails to differentiate itself from our simple do-nothing benchmarks. To be clear, the returns are not bad, they're just not good. So let's consider the implications. All that time and money spent by investment committees debating the allocation, all that time and money spent on sourcing and allocating to private funds, all that time and money spent on consultants, all that time and money spent on hiring new employees and CIOs, all that time and money spent on putting together endless reports to track the thousands of investments, all of it absolutely wasted. CalPERS would have been better off just firing their whole staff, saving the money, and buying some ETFs. Should they call Steve Edmondson, who, if you're not familiar, was famously Nevada's $35 billion fund manager who only owned a few ETFs in the Wall Street Journal. We got the link in the show notes. It would certainly make the record keeping a lot easier. Plus, they would save hundreds of millions a year on operating costs and external fund fees. Cumulatively over the years, the costs run well into the billions. Personally, I take the I part of the acronym very seriously and offered to manage the CalPERS pension for free. There's a quote from Twitter where I say, hey, pension funds struggling with underperformance and major costs and headcount, I'll manage your portfolio for free. I'll buy some ETFs, rebalance every year or so, have an annual shareholder meeting over some pale ales, maybe write a year in review. I've actually applied to the CIO role 3 times, but each time CalPERS has declined an interview. Maybe CalPERS should update their mission statement to deliver retirement and health benefits to, and you scratch out members, and replace it with CalPERS employees, private fund managers, and their beneficiaries. Because in this instance, they would be succeeding mightily. Now, is it just CalPERS, or is it the entire industry? One could look at these results and conclude CalPERS is an outlier. Critics might push back saying, okay, Meb, we get CalPERS can't beat a basic buy and hold, but let's be honest, it's the government. We define our government by mediocrity. Any serious private pension or institution should be using the smart money, the big hedge fund managers. Fair point. So let's broaden our analysis. We'll do so by examining the largest and most famous hedge fund manager in the country, arguably the world, Bridgewater Associates. This $100 billion plus money manager offers 2 main portfolios, a buy and hold all-weather strategy and a pure alpha strategy. In 2014, we set out to clone Bridgewater's all-weather portfolio in an old blog post. And this allocation that Bridgewater says has been stress tested through 2 recessions, a real estate bubble, a global financial crisis, and now the COVID crisis. The clone, based on a simple global market portfolio we talked about earlier, did a good job of replicating Bridgewater's offering when back-tested. And more importantly, running the clone would have required 0 hedge fund management costs and lockups and wouldn't have been weighed down by any tax inefficiency. Now, to be fair, This backtest has the benefit of hindsight and pays no fees or transaction costs. The all-weather portfolio, with its focus on risk parity, shows that if you're building a portfolio, you don't necessarily have to accept pre-packaged asset classes. For example, when it comes to stocks, they're inherently leveraged and most companies have debt on their balance sheet. So there's no real reason nor obligation to take stocks at their notional value. One choice is you could deleverage stocks, which would be to invest, say, maybe half in equities and half in cash. And the same goes for bonds. You can leverage them up or down to make them more or less volatile. This approach has been around for a long time, well over 60 years. Dates back to the days of Markowitz, Tobin, and Sharpe. The concept is essentially a super diversified buy and hold and rebalance portfolio, one that Bridgewater's founder, Ray Dalio, says he would invest in if he passed away and needed a simple allocation for his children. So clearly, the world's largest hedge fund should be able to stomp an allocation one could write on an index card. Once again, and we're using, since these funds were inception, so 1998 to 2022, we're doing this calendar year, and this is monthly, we find that a basic 60-40 or this global market portfolio, GAA, does a better job than the largest hedge fund complex in the world. Again, you can see the returns, volatility, Sharpe ratio, and max drawdown for all of these in the blog post. So one may respond, okay, Meb, all weather is supposed to be a buy and hold portfolio. They charge low fees. What you really want is the good stuff, the actively managed pure alpha portfolio. So now let's examine Bridgewater's actively managed portfolio. Dalio separated the all-weather portfolio from Bridgewater's pure alpha strategy, which is meant to be its multi-strategy go-anywhere portfolio. His idea was to separate beta, or market performance, from its alpha, or added performance on top of average market returns. He believes beta is something you should pay very little for, and we've gone on the record saying you should pay basically nothing for it in 2023. So let's now bring the pure alpha strategy into the mix. We'll compare it with all-weather, the traditional 60-40 portfolio, and the global asset allocation portfolio from our book, and above, finally, the risk parity strategy that uses some leverage. So we also did a test with the GA again, and a leverage of 20%. The replication strategy backtested the portfolios, again, between 1998 and 2022. So we're not going to dive too deep into the same table again, but what we can find is the returns for pure alpha were largely in line with the other portfolios. They were slightly superior to 60-40 and GAA, but less than the leveraged version of GAA. Again, the volatility was somewhere in the middle, and the Sharpe ratio was actually the highest. So for all weather, you had a 0.32 Sharpe ratio, 60-40 was 0.52, pure alpha was 0.55, GAA 0.54, and the leverage 0.51. And then the drawdown was, again, fairly mild. It is actually the lowest of the group. So once again, the returns of pure alpha were nearly identical to the GA and 60-40 portfolios, with performance differing across all of them by less than 0.5%. And don't miss out that pure alpha actually trailed the leveraged version of the GA portfolio. Again, it's not bad. It's just not good. Now, some may say, Meb, Dalio and the company did this in the 1990s with real time and real money. And we absolutely tip our hat to that argument. And additionally, the pure alpha looks like it takes a different return path than the other allocations, likely offering some diversification benefit from the non-correlation to traditional assets. We also acknowledge that the benchmarks include a particularly strong trailing period for U.S. stocks. Here's the problem, though. Many of these hedge fund and private equity strategies cost the end investor 2 and 20, or a 2% management fee per year and 20% of performance over a certain hurdle, usually. And sometimes it's just 20% of any performance. So you really have like a 10% annual gross performance, which gets you knocked down to a 6% net after all those fees. So yes, perhaps Bridgewater and other funds do absolutely generate some alpha. The problem is they keep it all for themselves. Regardless, it's good to see you can replicate a tremendous amount of their strategy just by buying the global market portfolio with ETFs, rebalancing it once a year while avoiding huge management fees, paying extra taxes, or requiring massive minimum buy-ins. So what's the relevance to your portfolio? Let's take this away from the academic and make it relevant to your money and portfolio. As you sift through year-end articles proclaiming how to position your portfolio for a monster 2024, or more likely given pundits' preference for gloom and doom, news of an impending big recession and a crash coming, as you stress about how much money to put into gold or oil or emerging markets as you lose sleep wrestling on whether U.S. stocks are too expensive, consider a more important question. Does it even matter? We did an old article where we said the best way to add yield to your portfolio is to spend zero time on it. If the biggest pension fund and the biggest hedge fund cannot outperform basic buy and hold asset allocations, what chance do you have? To all the pension funds endowments out there, hey, the offer stands. I'll be happy to design a strategic allocation for free. We'll save you the $1 million in base and bonus that CalPERS CIO role receives. And all that we ask is that maybe, just maybe, we meet once a year, we rebalance the portfolio, and share some beverages. Good investing, everyone. Thanks for listening.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.